All right. Today's Monday, the 2nd of June. Happy New Month. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. You know what's really interesting about the market today? There is a divergence that is worth noticing. This year, so far, we've been seeing the phenomenon when gold moves higher. We see the stock market heading down. We see rotations from the risk-on stock market to the risk-off defensive nature of gold. And so far, I see in the daily chart of gold futures a breakout, which means that gold probably going to reach all-time highs again. If that is the case, what does that say about the stock market? And you will see the importance of gold because it was the outperformer today. And you'll see the importance of gold as we begin to talk about the geopolitical risk that is flaring up right now. And as I said before, repeatedly in the program since years ago, that we are right now in the most dangerous geopolitical environment since World War II. We will talk about this in a minute, but going back to gold, you can see here in yellow you have gold, in white you have the SPX, the S&P 500. You can see the divergence. When gold rallies, we see equities down, and vice versa. When gold was sold, money was freed to chase the stock market. But today we see a divergence where we see equities and gold moving higher together. Of course, gold outperformed the market by a mile, but equities went higher, not lower. The question is it a trap? Are we going to see when gold goes higher, equities have to flip back down because we're only seeing inflows into gold due to defensive positioning by investors? Worried about geopolitics, worried about trade, worried about whatever. So gold's gains come at the expense of the stock market. Are we seeing a divergence for a day and then we wake up, let's say later this week, and we see equities down, gold moving higher, and we're back to the same correlation that we've seen so far this year? Or are we heading back to normalization, where we see gold and equities moving higher or lower together? And that's the most common relationship between gold and the equities market. They move together in tandem. There are periods of exceptions, as we've seen throughout the year so far. So the question now, is it a trap? Gold heads higher, equities will head lower again. Or are we going back to the usual correlation between equities and gold? Hold that thought for a moment, because you have another indicator. If we look at the dollar index in green, and then you have the equities market, SPX, the S&P 500 in white, you can see again that we have correlation between the two. They move higher together, they move lower together. But recently, we see the dollar heading down. And when I say recently, by the way, the last couple of days, dollar heads down, but equities still going higher. So are we going back to the same relationship where when the dollar goes down, equities go higher? Because that's the most common relationship. A lower dollar is good for corporate profits, specifically for companies with international exposure. But again, in 25, and honestly since the elections, we've been seeing the dollar and the equities market trading together. So what's up with this divergence? Is it going back to the old school relationship between dollar and equities? Dollar goes down, equities go higher. Or is it a trap? Is the equities market in complacency, for example, and not noticing what the dollar is doing? This adds up to the evidence from the observation that we just talked about between stocks and gold. And it is an intriguing question. What if we are indeed going back to normalization, where we see gold and equities moving higher together, when we see the dollar heading down and equities market going higher? For me, I settled the argument by looking at the third evidence that we got. Look at the correlation between HYG corporate bond ETFs. That's in orange, and you have in white, again, the SPX, the S&P 500. You see the correlation that's been going on for a few weeks, for a few months now. As we look at the hourly chart, if we zoom out, look at the daily, look at the weekly, they have pretty much perfect alignment. Why do we see the HYG heading down all of a sudden, as I'm highlighting, while we see the equities market heading higher? And you see the same divergence here, the same mystery, if you plug in the hourly chart of J&K, the high-yield junk bond ETF. We see it heading down, while the equities market ignoring that signal and moving higher instead. So to me, the evidence right now leans more toward, watch out, this could be a false reaction. And what could spoil the party? Well, right now, besides the dilemmas that we have in the bond market and in the trade situation, we're adding more to the misery by a massive flare-up in the geopolitics. And it's taking an ugly turn. And things could happen rapidly and introduce an additional catalyst that would lead to a global sell-off in financial markets. Let's talk about it, and here it is in Focus Tonight. It's a mad, mad world. And if you happen to be a regular fella like myself, and all what you want to do is just have a good time, make some money, take care of your family, your friends, eat good food, and jerk off once in a while. Hey, you don't want to bother anybody. Well, congratulations, because you're in the minority now. You're part of the Sane. And the Sane is becoming extinct species in this planet right now, as the highly contagious virus of the mad world continues to spread. And those who've been saying yesterday, not immune of becoming insane the day after. So again, we're part of the few now. There are only few of us who are in the sane category, and the rest of the world has gone mad. No regard to the desire of life, and no serious consideration to the consequences. Look, folks, I've been saying in this program for a long time that unfortunately, there is an event that's going to happen. It's going to be a financial event, and you're going to remember a world that existed before in a world that exists after, and the two are drastically different. You're part of the lucky, too, to have lived in the world before. And I'm not talking about the zombie apocalypse. I'm talking about a financial event, a massive recession, the likes that we've never seen since the 1930s. In it, we begin to see massive changes. The reserve status of the dollar becomes under question. The United States bond assurance is no longer good. We get stuck in weaker economic environment combined with higher inflation for a long time. Within that period, we will see the real emergence of AI. Companies will begin to replace millions and millions and millions of jobs, not just in this country, but across the globe, with AI. And that's going to leave a huge population of young people, at least, who are unemployed, who are hungry and angry. And that's going to bring up the questions of universal basic income and many others. Unrest, of course, across the globe. And the resolution to that will lead us to the deployment of all of these unemployed folks toward World War III. And you're already seeing in the geopolitical arena right now the beginning signs, the beginning flare-ups of what would lead at some point to the epic tragedy. But again, we go back, it stems from an economic situation. And we're already seeing the warning signs right in front of us. You see what's going on in the U.S. bond market. You see what's going on in the U.S. dollar. What used to be the best resource of safety, U.S. dollar, U.S. bonds, is no longer desired. As we continue to grapple with this debt monster that we got, which seems that the government has no interest in resolving it, they're adding to the deficit, and now there is a price to pay. That's the message from the bond market. The old days of printing money and getting away with it with no consequences, those days are over. Every penny you add to the deficit now will contribute to keeping interest rates higher. And we know that an economy that has been addicted to debt for over a decade now cannot withstand higher interest rates for a long time. And that's the catalyst for whatever you want to call it, the black swan, the global event that's going to take place in financial markets and the global economy. But rest assured, folks, you got Scott Bessent, who assured us over the weekend that the U.S. will never default on its debt. Never say never, Scott. And if you say that, hey, everything is fine while the building is burning behind you, you're now a clown. You're just a meme. And this will at some point lead to a massive recession, and then we're going to have AI taking over and the massive wave of unemployment and unrest and universal basic income, and then the big war. They got to get rid of you. Maybe at that point, AI is going to be smart enough to figure out that the best way to save the planet is to get rid of these dumb human beings. What is the best way to do that? Of course, start a nuclear war. So when we look at the geopolitical arena right now, looking at the map, you're beginning to see the signs of all of these little conflicts, combine them together later on, and they give you World War III. There are a few conflicts right now that are worthy of noting, and I'm showing you the world map. I'm pointing out where the U.S. really is, so you can see for yourself that none of this shit is our business. We should not be involved in any of this. These places are way, way far away from us. So keep that in mind as we talk about all of these conflicts. Why the hell are we involved? Why are our politicians, doesn't matter which party they are, always addicted to be involved to these foreign wars and waste our taxpayer money when we are a world away from all of these conflicts? But let's begin with the easy one here. You got India, Pakistan. Why is this conflict important? Because both countries are nuclear powered. And if we don't contain any flare-ups, any tensions, it could lead to a nuclear confrontation. And then it gets out of hand. But here's the good news. And I said this repeatedly when folks 2-3 weeks ago, whatever, they were talking about, hey, Mav, what do you think about India, Pakistan? Is that going to cause oil to spike higher? Is that going to cause the market to go down? Not really. I said not really. I'm not worried about India, Pakistan because of the following reasons. The United States, if we've done anything good in this world, we've kept these two countries as allies. So we have good relationships with both India and Pakistan, and we have a lot of influence in both countries. And likewise, Russia did not pick a side either. Russia has good relationships with India and Pakistan. So you have a lot of intermediaries that could come in, be it US, be it Russia, and stop the conflict. And this is exactly what happened. It took 2 days and then boom, it's over. When does it become dangerous though? It becomes dangerous because, as I said, US has good relationships with both, so is Russia, but not China. So if the conflict involves China, which is on the side of Pakistan because it sees India as an enemy, then the US and Russia will be forced to pick a side. US will be in the side of India, Russia will be in the side of Pakistan. But so long as it doesn't get to that point, I think this conflict is not the one that's going to flare it up. It might become part of World War III, of course, but it's not going to be the catalyst, the spark, if you may. But since we talked about China, here's the other geopolitical threat. We got China-Taiwan. Now, the rumors of an invasion of Taiwan has been going on for years. You hear about them all the time. But is the time that we're living in right now making it critical? Because you got to understand that Xi Jinping wants to do this before he dies. And the guy's not getting any younger, number one. Number two, you have to seize the opportunity before Taiwan becomes more powerful, as we see what's going on with Ukraine, and seize the moment. So when we heard the news over the weekend that the Secretary of Defense, Pete from Fox News, warned that the Chinese invasion of Taiwan could be imminent, and of course what he meant by Chinese invasion, he was not referencing the cocktail that he drank that morning, because the guy drinks all the time, was a lousy reporter in Fox News anyways, and this is the guy that we have to rely on. If the shit show happens, you gotta ask yourself a good question here. Do you trust Pete from Fox News to handle World War III? Anyways, he meant the actual Chinese invasion of Taiwan, and he said imminent. What is imminent? Today, this week, this month? Who knows? Of course, China accused the defense secretary of spreading false news, and there is no imminent plan to invade Taiwan. China also warned the US not to play with fire, quote unquote, over Taiwan. Now, suppose we wake up tomorrow, for example, and we see China already invaded Taiwan, took it over, the whole thing is gone. Would the world fall apart? Would anything really change? Would something happen in Missouri because Taiwan fallen? Of course not. So why is it our business? But yet we're going to make it our business. Because the defense secretary says that if China invades Taiwan and seek to conquer the island, we will come to the rescue of Taiwan. And we're not going to send a bunch of ladders and ambulances. By rescue, meaning we're going to fight for them against China. And that's World War III. That's insanity. Of course, there will be an economic impact from the invasion of Taiwan. That's where the world, not just us, all of us, get our chips from. And chips right now, semiconductors all over the place. We can't have a functioning economy or functioning life without it. Now, we're shifting manufacturing from Taiwan to the US and other countries. The United States is also restricting sales of advanced AI chips and equipment to China, not just from US companies, but also European companies, Asian companies, and Korea. What if China wants to respond by saying, okay, you want to cut us off? We'll cut you off. We'll take Taiwan and cut all of your supply, and then we have an equal battlefield. So I know that we've had a lot of times when we heard, oh, China's invasion of Taiwan is imminent, but now we have a catalyst for it. Now we have a real reason of why it could take place. So I take it with seriousness. But the main concern, of course, is what happens after China invades and takes over Taiwan. Are we going to get involved? And have we really thought about all of this? Is what we're seeing in the trade situation between US and China and the decoupling that is becoming evident by the day, is this part of the preparation of a greater war with China? Something to keep in mind. Now, the other, perhaps the most dangerous geopolitical situation that's going on right now is the Russia-Ukraine war. Again, look at Ukraine, look at how far it is from the US. Why is it our business? Really good question, isn't it? But we have right now the peace talks happening in Istanbul. Maybe I'm skeptical, maybe I'm a little bit on the pessimistic side, and I hope I am. I hope I'm wrong about this, but I don't expect any good resolution coming out of this. I don't expect a peace deal to happen because of these talks. What I see is more escalation and the situation getting more dangerous. See, over the weekend, Ukraine launched a really sophisticated attack against Russia using drones that they implemented inside Russia. Then they launched the swarm of drones to attack Russian strategic nuclear bombers. Now, it is part of the New START deal, the nuclear treaty that we have, US and Russia, that we keep the strategic bombers visible, and that makes them sort of sitting ducks. And that opens the question now, is it a fair game if somebody attacks our bombers that are parked in the middle of the country using drones? We've seen drones in New Jersey, we couldn't even identify them. They said they're UFOs. So isn't that dangerous that now anybody can use the same tactic and hit our strategic bombers? What about the nuclear treaty now? What if both of us decide to hide these planes and not disclose them anymore? That's another thing to think about. But of course, hitting these strategic bombers, part of the nuclear tirade of Russia, that could trigger a nuclear response. Russia nukes Ukraine. Now, do I think they're going to nuke Ukraine and bomb Kiev, for example, and kill millions of people because of this? I don't think so. And you know who's the guy who's stopping it from happening, by the way? It's Putin. So if you think Putin is crazy and he should be eliminated or assassinated, you better be really careful what you wish for, because whoever takes over after Putin, assuming they could be Medvedev, could be one of the generals. A lot of them are lunatics. A lot of them want to go nuclear right away. They've been pushing for nuclear response from the get-go, but Putin wouldn't do it. But after this attack, are we going to see a deployment of tactical nuclear weapons by Russia? Sure. And I think that's going to be the most likely response by Russia, that they're going to attack Ukrainian bases, military bases using tactical nuclear weapons that are mounted on hypersonic missiles. Okay, so Russia uses tactical nuclear weapons to hit Ukraine. Now what? Do we nuke Russia? What do we do? Are we obligated to do anything? What about the European response? All of these are cards on the table right now and opens a massive can of worms of uncertainty. And I think that the markets right now are utterly complacent. As Jamie Dimon said, when you see all of this situation that's going on right now and you don't think about what would the consequence be, you got to begin to think again. But the good news is there are things we can do as investors to capitalize on all of this. We'll talk about that in a minute. But the other geopolitical situation that is absolutely dangerous right now is what's going on Israel-Iran. Now, before we talk about Israel-Iran, it is noteworthy to talk about what's going on between Israel-Palestine first, because I think the most important geopolitical outcome from all of this is there is massive amount of anger in the Arab countries. Now, I'm not talking about the governments, I'm talking about the population. In the next recession, which will probably be accompanied with a stagflation phenomenon as we see prices of cotton and commodities like wheat and corn going significantly higher, I think that's going to be the catalyst for an Arab Spring 2.0, as we've seen in the early 2010s. And I think we'll see a lot of governments falling like dominoes. And then a vicious movement will be born, and you can fill in the blank from that point on. But let's go back to Israel-Iran, because that's the most immediate situation that we got right now. We got the news, and this was a couple of days ago, so I guess it expired now, but it's worth talking about. We got the news that Iran Defense Ministry said that Israel is planning to bomb their nuclear facilities within 48 hours. Now, President Trump talked about this in his latest, when he was asked about tacos and all of that. He said that, he warned the Israeli Prime Minister Netanyahu, don't do it. We're still negotiating, don't do it.
Back on Iran, did you warn Prime Minister Netanyahu against taking some sort of actions that could disrupt the talks there in a phone call last week?
Well, I'd like to be honest. Yes, I did. Next question, please.
Well, guess what Israel is going to do? They're going to do it. Because what is the consequence if they do it? And they're probably going to use a bunch of jets, F-35s, and shoot a bunch of big bombs on some of these nuclear sites. Maybe they'll do some damage. Maybe they'll take some of them out. Who knows? But it is, of course, most likely that Iran is going to respond by two things. Number one, causing the global oil market to flare up by closing the strait. That could be a weapon in their disposal. And of course, landing thousands of missiles on Israel right away. Some of them could be equivalent of a nuclear bomb when you combine all of them together. Then what happens? Are we going to leave Israel and just allow Iran to shoot all of these rockets and missiles and maybe do serious damage to Israel? We're not going to do that. Why? I mean, I don't know. Your politician seems to be in love with Israel. Even though looking at the map right now, it's worlds away. Whatever happens over there, they nuke each other. What do we care? But knowing our government, of course we're going to get involved. Of course we're going to come to the rescue of Israel and bomb Iran and start a new war. And oil markets, the Third World War, who knows? And the same thing in Ukraine, by the way. The war in Ukraine is going to end in one of two ways. It ain't going to be via peace deal. It's going to be either we have a global recession that handicaps the ability of the U.S. and the European Union to fund the war and fund Ukraine to continue to fight the war. then Ukraine has to succumb to Russian conditions and surrender. That's one way to end it. The other way is Ukraine is going to continue to poke Russia and cross red line after red line after red line until they cross that one red line that triggers a nuclear reaction by Russia, and that ends the war. Ukraine loses. But then what happens after? Do we get into a war with Russia? Do we nuke Russia? What do we do at that point? It is just one mistake away, one miscalculation away to get the shit to hit the fan. And the whole thing begins. And then you can't go back. There's no point of return at that point. As I said, it's a mad world. I can't change it. I can just be on the record here saying that not my business. I just want to live, have a good time, eat good food, take care of my family, my friends, and jerk off once in a while. Why do I have to die? Because of the insane and the mad world. But until the chips fall wherever they may, we can't do anything about it. What we can do is adjust our portfolios or investment strategies based on what's going on with the geopolitics. So let's talk about the strategy. Now we'll share with you an investor strategy and a trader strategy. One step at a time. Today I gave my members morning brief. It is longer than usual, but I think it's worthy. It's worth talking about all of this. And it's worth going over again. I said this week we have critical developments that will impact markets. Number one, geopolitics. The Russia-Ukraine war took a dangerous turn toward nuclear escalation. Intelligence sources suggest that Israel will strike Iran nuclear facilities without U.S. approval in 2 weeks' time frame. And intelligence sources also suggest that China is speeding up its plans to invade Taiwan, which our Secretary of Defense, Cocktail Pete, suggested that the U.S. will rush to defend. Talking about Taiwan, of course, which means we fight a war with China. Geopolitical chaos is causing a rush to safety toward hard assets that are alternate to the US dollar, such as oil, gold, copper, palladium, wheat, and foreign currencies, like the Japanese yen and the Swiss franc. I've been screaming at the top of my lungs to buy the dip in metals as I see another sharp decline in the US dollar coming. Copper's dip is already missed, because copper was up 4% right off the gate today. If you didn't use last week's advantage to buy the dip. And soon enough, gold will make all-time highs. You want to miss on that too? Real long-term investors need to position themselves in these assets instead of chasing the fake dips in the dying technology/AI trade. Which, by the way, the majority of names been flat since last July. It's going to be almost a year. They've been doing nothing at all because we squeezed that juice and there's nothing left. So you have to begin to change your mentality here. I'll give you an easy guideline in a minute, but the second point is the trade war. You got Trump doubling the steel tariffs to 50% from 25%, and negotiations with China falling apart. Scott Bessent tried to put a lipstick on a pig over the weekend by suggesting that Trump will call Xi and iron the differences out. Meanwhile, China says that there is no phone call scheduled between the two leaders. Well, now they say there is a call. At least the White House says we're going to call Xi. We'll see what Xi says tomorrow. But the truth is the trade situation will deteriorate, not just with China, but also with the European Union and Canada. And by the way, even Japan. Because Japan is now demanding that you got to drop all the tariffs before we begin negotiating. And don't forget, of course, the court decision that happened last week. What does that say if you're the trade representative of Japan or EU or Canada or Mexico? You have no incentive to negotiate right now. You want to wait and see how the chips will fall. Maybe the courts will block his ability to do the tariffs. Maybe he's just going to continue to taco. And at some point, taco will become burrito because he's going to get to a point where he can't taco anymore. He's going to get really, really mad and go crazy with the tariffs again. Anyhow, this dynamic will re-accelerate the Sell America trade, which means that the US dollar and bonds will continue to be sold, which means that betting on hard assets alternate to the US dollar is a solid position, along with shorting US bonds. On the long run, of course, the 10 to the 30, I'm shorting the TLT, for example, but you can be long the short end of the yield curve. You can be long the bills, the notes, all the way to the 2-year. I'm sticking to the bills, and this is why I said my strategy is buy bill, B-I-L. That's going to give you exposure to the 1 to 3 month bills, the Bloomberg index, and then short the TLT. Now you have a balanced exposure. But since both the geopolitics and the trade suggest that assets that are alternate to the US dollar are the place to be, and it has to be a part of every portfolio. Sure, maybe you don't want to abandon your tech positions. Maybe you're going to be one of those late arrivals. The once your position, which was up 50%, goes down to only up 20%, maybe then you feel the urgency to get out. Maybe some of you will wait till you get back to negative. and then feel the urgency to get out. But what is the harm in adding some defensive positioning in your portfolio? So when we look at the bear dollar trade, let's go clockwise. You can buy foreign currencies, including the Japanese yen. It has been part of the recession play. If the dollar goes down, the value of the Japanese yen goes higher, and we talked about how the Bank of Japan has no other alternative but to firm up the yen to combat the inflation problem in Japan. You also have the most reliable, the king, the old man gold. It's been hot, and it protects you from stagflation, recession, geopolitics, trade, sell America, doesn't matter. Gold is the place to be. Then you got silver, of course. I don't know why would you have to go with silver if gold is available. Maybe because it is cheaper, but again, it hasn't been moving as reliably as gold. So you're missing out here. For me, I'm just going to stick with gold. There's no need for me to accumulate silver at all. But I am buying this metal right under silver, which is copper. Copper been hot, holding pretty good, the everything metal. And at the end of the day, the mining expense is going higher and higher and higher. So we have a shortage of supply. And whether we have a recession or no recession, the demand for copper will continue to increase as we see the adaptation of AI. Then you have palladium. When we see the dollar heading down, palladium begins to appreciate in value, and guess where palladium comes from? Made in Russia. Then you got Bitcoin. To me, this is not reliable yet because Bitcoin hasn't been tested. Bitcoin has been passing a lot of tests. It's been trading for the most part along with gold, acting as digital gold, as many of the proponents of Bitcoin been arguing for years. But the real test would be what happens, because the same holders of Bitcoin are the holders of the big cap technology stocks. What happens if we see a mass exodus in the big cap technology stocks? Now they're down 20-30%. Will we see margin calls in Bitcoin to cover for what's going on in the equities portfolios? If that is the case, then Bitcoin fails the ultimate test, and it is not a digital gold, but rather a risk-on asset. And this is why, for me, why would I bother buying Bitcoin when I got gold? And of course, when the dollar goes down, international markets appreciate in value. Believe it or not, we have markets that are up 20% plus. Be it European equities, Asian equities in Korea. The Spanish stock market is up about 40%. The Mexican ETF is up over 30% this year alone. When you see depreciation of the US dollar, we see appreciation of foreign assets. You also have wheat. It hasn't been participating, but as we begin to see the geopolitical flare-up in Ukraine, huge producer of wheat, and the new crop season begins to hit. You got to remember, a lot of our farmers, when wheat was surging higher in 22, a lot of folks overplanted wheat to capitalize on the mania, and that led to oversupply of wheat. But then the weather got bad, and the farmers decided to go with corn instead of wheat. And now we're getting to a point where we see in the next crop season that we're going to see shortage in wheat. And with a lower dollar, we should see appreciation in wheat prices. Of course, you can buy the ETF, the ticker WEAT. If you don't trade commodities, that's going to give you exposure to wheat. And the same thing for palladium. You can pick the ticker PALL. That's going to give you exposure to palladium without trading the futures. Now, as far as gold and copper, you can trade the miners. That's okay. But you got to remember one thing in mind. The miners are part of larger ETFs. If we see these ETFs getting dumped, they're going to dump the miners with them. So maybe they're going to gain overall, but they're going to lag and underperform the actual commodity. Keep that in mind. Of course, when the dollar goes down, oil goes higher, specifically with geopolitical flare-ups, but not my favorite hedge, to be honest with you, against the dollar right now, because if you grab a chart of the dollar and oil, you'll see correlation as of late. And the reason is when the dollar goes higher based on less recession fears, oil also goes higher. But right now, we have stagflation in the economy, and a lot of other economies are going weak and dipping into a recession. And the recession odd in this country has not been eliminated. So oil has a lot of challenges too. I know it's up big today, over 4%, might catch a tailwind from short covering because of the geopolitical flare-ups. But the reliability hasn't been that good when you compare it to gold, for example. And the last one I got for you is the Swiss franc, aka the Swissy. And I have both. I have physical and I have ETF. So you can go with the FXF, that's the ETF for the Swiss franc. You could go with the FXY, that's the ETF for the Japanese yen. But I also have physical Swissy. They look pretty, by the way. They're nice to keep. And they'll look prettier if they continue to gain value. You see the performances of this basket of commodities that I picked for you. You see crude oil or gasoline, heating oil, gold, silver, copper, wheat, palladium, all of them gaining and closing positive for the day. Now, the other thing that you can do, because a lot of folks would say, what about the defense contractors? What about Lockheed, Northrop? If we had World War III and we have a flare-up in the geopolitics, shouldn't I be in defense? Sure. And recently I've added LHX, for example, in my portfolio. Harris, I think at the weekly chart, we're seeing a cup and handle pattern. I think we go higher in this name. And then I have Raytheon in the Maverick portfolio. It's been doing pretty good, so we'll keep it as it is. Now, what about Lockheed's and the Northrops of the world? The problem with these classic defense contractors is they have long-term fixed contracts that already happened, but the manufacturing of the items is happening right now under inflation. We talked about steel tariffs, 50%, aluminum tariffs, 50%, the inflation in other components. So net, they're losing money. They're having a hard time pulling a profitable quarter because they can't ask for more money. They can't do price gouging on the contract that already was fixed and signed, but they have to incur the extra cost. So those might not give you the best return. Now, if you happen to be a European viewer, just stick with the European defense manufacturers. Why? Because the increase in the defense budget in the US from $850 billion to $1 trillion isn't that significant when you compare it to European increase in defense budgets. In some countries, we're talking about over 50% to 100% increase in spending. So the European defense contractors will gain the most. How can we play this as US investors? With no access to European defense contractors individually, you can look at the ticker NATO, NATO. It's flying to the moon. And if we have any flare-up between Russia and Ukraine, you will see more appreciation, more defense spending in Europe, and these names are going to appreciate handsomely. You have another choice in the ticker EUAD. That's for the European defense contractors too. It is doing as good as NATO, so pick your pick here and keep that in your portfolio. If you're betting on geopolitical flare-ups, it should be part of your portfolio. Let's go back to the morning brief because we have another important catalyst coming out by the end of the week. And that's the third point, the jobs number. If the jobs number come out weak, it could be a double-edged sword. Of course, it's going to increase the recession odds, maybe freak out the equities market, but at the same time, it's going to tame the increase that we've seen today in crude oil prices. It could also lead to stability in the bond market, as we see this recent surge in bond yields maybe stopping, halting, or reversing altogether. If we're losing jobs in the economy, if we're not producing enough jobs, if the number is anemic, but what if the number is average? The plain vanilla number that they give us all the time. If that is the case, then the same dynamics continue. We're going to continue to have stagflation in the economy. Folks still got their jobs, but their spending power is being reduced. And what is that going to be good for? Certainly not good for anything cyclical. It's going to be good for credit card companies. It's going to be good for the stores where we see the consumers downgrading from one class to another. For example, if you used to shop at a certain store, but now you can't afford it anymore, you're going to downgrade to the next store. And this is why we see Walmart getting a lot of affluent consumers. We see in the clothing brands, the high-end, maybe not doing so hot, so folks who used to buy that crap are downgrading and buying something more affordable now. So you see Tapestry, for example, outperforming the expensive brands like LVMH. Now, as traders, because we just talked about investing strategy here, what do you need to add? As traders, what do you do this week? Simple guideline. You got to watch two things. The E-mini futures, S&P 500, 5,900. And you got to watch the VIX 20. If we have a combination of the E-mini futures trading above 59 and the VIX trading below 20, then all what you can do is assume that we have more upside risk. And if you're trading zero DTEs, go with the calls. Nothing above 1%, of course, because you don't want to go crazy. And this strategy has been working out pretty good. If we see, which means, by the way, that you buy the dips. If you see a dip, but we're not below 59 and the VIX is not above 20, that means that the market is going to move higher. But if we see the E-mini futures below 5,900 and the VIX above 20, then even if you see a gap up in the morning, you want to short that because we're probably going to head down. You want to buy the zero DTE puts, again, nothing more than 1% to break even, of course. And that's going to be a reliable strategy. So just follow the guideline for now as traders until we get out of this consolidation range that we've been in for about a month now. Now, more in the trading strategy, I give you concluding notes on Friday on Discord. So I gave this right here. And notice the strategy that I'm doing via options right now. I'm taking the opportunity of playing the market maker and riding a lot of options. Instead of buying, I'm selling a lot of options, opening credit spreads, corridors, and raising cash. So for example, one of the updates that we've done, if you recall the strategy from last week, I sold the 5,700 E-mini futures puts and I bought the 56 as a put credit spread with the expiration date of last Friday. But that expired worthless, so I got to collect the entire premium. Then I have another trade where I'm buying the 5,700, selling the 5,600 E-mini futures puts, expiration date June 20. If there is a pullback, 57 or below, I got exposure to it, and I got exposure cheap by combining my strategy with a credit spread strategy. Number 2, we got the diagonal JPM 250-240 put spread. So what we've done is it's a diagonal. We bought the 250 puts for June's expiration, and we sold last Friday's 240 puts. Well, we know that JPM closed above 240, so that expired worthless as we needed to. Now we have the entire premium. What we've done here is we opened the 240, selling the 240 puts, same expiration date, June 20. Now we have a put debit spread. It has a good chance of working out, but not the best chances. Unless, of course, we see a sharp reversal, we see the VIX above 20, then it's not going to take too long for JPM to head below 250. Now, number 3 is really interesting because it is an advanced strategy that I've done before NVIDIA's earnings. And I collected the entire premium, almost 95% of it. What was the trade? Here it is. Before NVIDIA's earnings, I want to play all outcomes. Maybe it's going to go higher above the market maker's pricing, which market maker was anticipating a move of 5% in either direction. What if it is 10 though? So I had exposure at the 150 calls calendar spread combined with the 150-160 debit spread for the expiration date of the 6th. I've done the same thing in the put side. Bought the 125 for this week, sold the 125 puts expiration date last Friday, having a calendar spread. And on top of that, I sold the 120 puts to have a debit spread right off the gate for the 6th. At 120. What if the market maker is right though? And we see the movement within 5% range and we don't see NVIDIA moving much. I did a short straddle. I sold the 137 calls. I sold the 137 puts. All in all, netting a credit of about $900. And guess what? NVIDIA didn't move much. All in all, didn't move much. So I got to collect about 95% of the premium right now. You got to play market maker, folks. And then number 4, we got DJT. This is a bet against Donald Trump, whatever scam he's doing with the cryptos right now. We have the 20 calendar puts. We sold last week, bought this week. We'll see how it's going to work out. Not a really important trade, but it could work out pretty good if we see a flush in DJT. Now, Tesla has been a little bit challenging last week because it's been going higher based on the robo-taxi optimism coming out of Austin on July 12. That's going to be about 10 cars. Mind you, Waymo did 700,000 rides in California. So Tesla's way behind the game. And you have the culties jerking off to something that we already have, which is robotaxis. And that's why the stock went higher last week. But number 5, I think we'll see sell the news as we head closer to this when Reverend Elon Musk splits the Red Sea with his robotaxis. Then everybody realizes that, robotaxis went haywire and killed somebody. Anyways, if we see it sell the news, I want my exposure because we had the 325, 315 put debit spread with the expiration date of Friday. That didn't have a lot of money left in it. It had about $1.25, so we took that and deployed it in another trade that we got, which is the 340, 330 put debit spread expiration date June 20th. And so far the trade is profitable because here's the date when we've done it, May 27. And we paid about $350 for it. Right now it's trading about $450. So far, so good. Number 6, we got the Apple 210-200 put debit spread. Expiration date was last Friday. It was going to expire in the money, so you can have your broker cancel both trades and you net the full premium. But why jerk around with it if we close above 200 and then have one leg exercising and the other one not exercising? So I closed the whole trade, netting $9.60 a piece. Still a massive profit. That leads us to number 7, average down 1-1 on the EWG 41 puts and DB douchebag 27 puts, expiration date June 20. So a bet against Germany. Not working out so good so far, but maybe we need to extend it all the way to July because I don't think we make the deadline. He said by July we're going to have a deal with the EU. I don't think the EU is going to be ready, nor interested, to be honest with you. Because what if the court's going to dismiss the case altogether? And at some point he's going to feel squeezed. We're talking about the president, of course, and he's going to have to lash against something. If it is not China, because he had a nice call with Xi. He was so nice. He complimented him. He might strike against the EU, and we see German equities getting hit the hardest. We also added some bets against some big caps that are looking the weakest. Of course, Microsoft, Meta, NVIDIA looking the best, but you have Google, Amazon, Apple not looking so hot. So let's add some cheap exposure here to the downside. Google 165, 160 put debit spread, expiration date June 20. Amazon 200, 190 put debit spread, same expiration date. Along with Apple 195, 185 put debit spread, same expiration. We've also done a short in the TLT, bought the 85 puts, expiration date June 20, with the intention of converting it into an actual short, shorting the TLT for good. Cost about $1. It's already in the money. If it expires in the money, we're going to exercise it and short the TLT. We've also added gold miners. GDX been on fire. 50 calls again. June 20 costs us about 180. Here's what we've done today. We've opened the 55 calls. Now we have a debit spread. Same expiration date, June 20, GDX 50. We sold 55, raising a credit of about $1.20 a piece, knocking the entry price down to 60 cents, while the max profit is $4.40. So pretty good risk versus reward. Anyhow, folks, this was an extensive coverage. We talked about the macro, the geopolitics. We talked about the trading strategy, investing strategy. So we're going to wrap it up right here. But if you happen to be a member of this channel, before the opening bell tomorrow, you're going to receive a bonus video, the Charts to Watch monthly edition. We're going to look at monthly charts across the board, and I'll show you exactly charts that I'm interested in shorting or longing, and what the triggers would be based on the monthly charts. So these are long-term kind of plays. So be on the lookout for that one. But let's segue to the conclusion of this video. What do we have on the economic calendar tomorrow? We got factory orders, we got job openings, and then we got a bunch of Fed zombies talking. What do we have in the earnings calendar? We have CrowdStrike, that's important always in cybersecurity. We have DG, Dollar General, that's a pulse on the not-so-affluent consumer. NEO's important, Chinese electric maker. Then we have SIG, Signet Jewelers, that's the affluent consumer. So we still have some important earnings, despite the fact that the juiciest part of the earnings season is now behind us. And with that, folks, let's just wrap it up right here. Thank you for joining us tonight. If you found the information presented in this video informative, please return the favor by pressing the like button, subscribing to the channel, leaving us a nice comment in the section below, or consider, better yet, joining us as a Maverick member to access the daily and bonus videos and access the Discord benefits too, either here on YouTube or in Patreon. Links in the description. But with that, folks, thank you for listening. Thank you for watching. I appreciate and love all of you. Stay sane and good night.
Their tears are filling up their glasses. No expression, no expression.